Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Thursday, the 18th of July, 2024. So before we start our Daily Dose of Market Insights for today, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into our short-term intraday technical outlook for today, I would like to share with you very interesting developments that has taken shape yesterday in terms of the news flow, the event, and how this particular news flow and events has an impact on the various respective performance of the major cross asset classes. So let us start with the news flow and a release of the economic data yesterday first. All right, so what we see yesterday over here is that the UK inflation data, which is one of the key data that was released yesterday, as you can see my screen over here, the core inflation rate in UK came in line within expectation, 3.5% year on year. So there's actually no change. Okay, so indicating to us that the inflation trend in the UK is still on the path of deceleration. Okay, if you could look at the chart over here, let me share with you. Okay, give it a couple of seconds to load. Yeah, so it's clearly on the path of very clear deceleration since September last year. All right, so that should more or less increase the possibility that next month Bank of England will start to ignite its first interest rate cut. All right, but however, what's interesting over here is that the markets continue to actually push up the sterling dollar. That means, i.e., yesterday we continue to see a resurgence of this dollar weakness coming back into the picture. We got to respect the price action of it. And one of the reasons over here is that the release of this, I would say that the catalyst of this price weakness on the US dollar is much more related to momentum play rather than this UK core inflation data that is driving the movement of the dollar, the FX market yesterday. And also yesterday over here is that we do also have, during the later part of the US session, we do have some Federal Reserve officials that are also in line with their big boss, which is the Fed Chair Powell. At the start of this week, in his public speech, Powell actually did mention that he's getting more confident that the US inflation trend, i.e. inflation trend in the US, is on the path of deceleration, but he didn't use deceleration, he used subtly hitting the Fed 2% target, which gives them much more evidence to kickstart a interest rate cut cycle starting from September. So even Weller yesterday also echoed very similar sentiments or viewpoint by his boss, Fed Chair Powell. So he said Fed is getting closer of cutting rates. Okay, but he always put a caveat behind, not there yet. But market view this as actually dovish and push down the US Treasury yield, both the 2-year and 10-year much lower, thus reducing the US Treasury yield premium against the rest of the world. That means, i.e., we take the US Treasury yield minus the rest of the world government bond yield, the US yield premium is getting lesser as of yesterday, which also put downside pressure on the US dollar as well. Okay, and the thing over here is, usually when we start to see a weaker dollar, it should be very supportive of the stock market as per say in general. But however, yesterday US stock market actually got a sell-off yesterday. So if you look at the US stock market performance, was pretty bad in the two heavily mega cap technology weighted benchmark stock indices, which is the S&P 500 and the Nasdaq 100. So the S&P 500, after hitting a fresh 38 all-time closing high on Tuesday. Yesterday it plunges by negative 3.9%, and it starts to sell off throughout the US session. And the worst hit was the much more heavily weighted semiconductor, heavily concentrated Nasdaq 100, which has a significant weightage on the market leader related to semiconductor AI GPU chip, which is NVIDIA. The Nasdaq 100 actually tumbled close to 3%, down negative 2.94%. And yesterday's fall on the Nasdaq 100 is the worst daily performance since December 2022. So if you look at the trend of the Nasdaq 100 over here, it also sold off at the start of the US session and starts to remain rather weak, I would say, throughout the US session until it closed near the low of the US session at the 4 a.m. mark over here. And what's interesting, we did highlight over here, is that the Dow Jones managed to actually buck the trend by positive of 0.59%, and it starts to close higher at the top of the range. So what we could see over here is that a very interesting interplay in the market right now, where the Dow Jones, which is the value oriented, heavily weighted index, is now outperforming the benchmark, heavily high mega cap technology weighted benchmark like the S&P 500 and the Nasdaq 100. So for those who joined my daily dose since late last week, I did mention about this value factor that is going to get outperforming in the US stock market by plotting that value ETF against the normal S&P ETF. All right, so later I'll flash that chart again. So this story is actually, this narrative is playing out right now due to the potential bull steepening of the US Treasury yield curve. And yesterday price action has started to show pretty much evidence. And also despite the fact that there's also one particular news flow that causes the negative performance or underperformance of the S&P and the Nasdaq 100, much more related to the semiconductor US stocks. Why? Because yesterday, the current Biden administration is now thinking of having a tougher trade rules to rein in the China chip technology sector. That means i.e. or the China chip making industry, preventing them of getting any technology know-how to build much higher end and faster processing semiconductor chip. So what he did over here is that US administration right now wanting to sound pretty tough, and as we know that right now we are coming very close to the US election, and based on the turn of event that took shape on last Sunday and Saturday, where there was this failed assassination attempt on Trump, and based on that particular event, it actually turned the tide more favorable towards Trump right now in terms of stoking the conservatives camp in the US, as well as some middle ground voters to sway towards Trump in the votes of patriotism or the face of US conservatism, and as well as the tagline of "Make America Great Again." So right now, it seems to us that Biden is now trying to play this catch up by enforcing more conservative, far-right favored policy to actually cover the popularity gap between Biden that is lagging right now against Trump. So yesterday, Biden administration actually floated this idea. It's a very, very strict idea. That means any little signs of, despite that, let's say we do registered, that means not only US, that means he wants to get US airlines like Japan, and as well as the Dutch ASML. So we know that ASML produce a very unique chip making product that only ASML has a technology to do so, to actually form part of this higher end chip making process, and also get involved with Tokyo Electron as well. So the thing over here is that US right now is trying to get airlines, not even US based semiconductor firm, but it's airlines like ASML and Tokyo Electron, to further prevent any of their product being sold to China. So despite, even though it may not come from them, the country directly, but let's say if ASML decided to shift their plantation elsewhere, like in some of the Southeast Asia company or Southeast Asia country or other region in the world that don't originate from Japan or in Europe. What US want over here is that you are still liable to prevent your chips from, even though this chip is not being produced in your homeland domestically, they shouldn't be actually falling into the hands of the Chinese market. So with this much more tougher rules, it's actually causing a sell-off in the semiconductor stocks in the US. So if you look at the very interesting in the S&P heat map yesterday, you see an entire rate in the semiconductor industry. Nvidia down negative 6%, and it start to spread into the rest of other mega cap stocks as well. So what we see over here is that even though Apple is not part of the semiconductor, we call it industry, whatever, inside the semiconductor industry, but it have a negative spillover effect because it forms part of the mega cap technology group that is riding on high on AI related team play. And don't forget, Apple stocks only rose at the second half of this Q2, where Apple decided to actually come out with AI driven iPhone model next. All right, so even Google, Meta, Amazon as well, they have some form of AI capability product suite in their wider range of services that they are offering in their main business. So because of their interrelated play with AI, this Nvidia related more on the chip AI industry causes this negative feedback loop spearing across the rest of the mega cap cohort. And what's interesting over here is that this spread of this we call it a rate sell off doesn't actually spread throughout the entire US stock market. As you see, other industry inside the S&P 500 like healthcare, there's still some parts of green. Industrial a bit mixed over here. Consumer staples, that's more on defensive, outperformed yesterday. Even you have materials, utility, real estate also showing more greens, and the financials also actually outperformed yesterday as well. So that actually explained to us the other component, we call it sector in the S&P 500 that is much more value oriented, managed to help the fall yesterday. Okay, so later I'll share with you on the intermarket dynamics as well. Okay, so now with that, this is the key news flow that has taken shape yesterday. Two of them, basically, number one, the potential US tougher rules. The US current Biden administration wanting to enforce these tougher rules on US chip and as well as airlines, semiconductor chips firm in Tokyo, in Japan, and as well as in Holland, that causes this negative feedback loop in the AI as well as semiconductor chip stocks that actually causes this negative spillover effect to other mega cap technology stocks. All right. So with that, now let me now switch our focus now to focus more on the intermarket dynamics. Okay, so let me start with the FX market first. So on the FX market over here, what we could see on this heat map over here, not heat map, the 5-day rolling performance of the dollar against other major currency. So what's interesting over here is that, in fact, the one that suffered the most, that means the dollar actually weakened the most against the Swiss franc and against the dollar yen over here. So you look at the rest over here, yes, it did came down a fair bit at the during the European session. When the European session started, it actually plummeted, but the way the plummet over here is not so extreme as being seen on the dollar yen and the dollar Swiss. And thereafter, during the US session, it starts to trade sideways as well. Okay, so the reason over here I want to share about why the dollar yen actually plummet the worst is due to that market participants right now is having a much more fundamental reason to supports a potential yen strength, at least from a short-term to medium-term perspective, by looking at the US Treasury spread against the JGB. So this particular chart I did flash before in a couple of my daily dose, we call it session. So let me explain this chart. What does it mean? So this chart itself over here is telling us the yield spread between the 10-year US Treasury yield and the 10-year JGB yield, and the bottom one is the shorter term, the 2-year Treasury yield minus the 2-year JGB yield. So I did mention previously earlier, there's a key support to look out for in this yield spread, which is the swing low of last December and early February, where it managed to help as a support at 3.19%. And yesterday, it actually broke down below this 3.19% mark over here. So it's a breaking down of a major, I'll say it's a medium-term support level. So with this breakdown of this support level, it indicates to us that the yield spread between the US Treasury 10-year yield and the 10-year JGB is getting lesser and lesser, potentially going forward. And the next support level we are looking at, okay, will be at this, 1 second. Okay, it's a bit slower right now, my internet connection. Okay, hopefully it doesn't hang. Okay, good. Okay, will be this range here. This I would say not range, this congestion area, okay, at 2.89%. So what it means over here is that the premium between the US 10-year Treasury yield and the JGB yield is getting into a shrinkage situation, where i.e. US Treasury is not as attractive as before as the JGB. Or what it means over here is that if we use the yen as a carry trade, that means i.e. we start to short yen and long, means we borrowed in yen, and with that proceeds we long higher yield related currency like US dollar itself or other currency like the Aussie or Kiwi. This particular carry trade strategy using yen as a funding currency is not as attractive as before. Okay, so this is what it actually telling us right now. So, and in fact, the lower end of the curve, the 2-year minus the Treasury yield minus the 2-year JGB yield is also showing the same signs of movement as well, with the breakdown of this medium-term support on that was held since the start of this year at 4.12%. And right now it's actually, yesterday it broke down and now it's trading at 4.09%, with the next support coming in at this congestion area over here, which is at 3.84%. Okay, so there's much more room ground to go. So net overall, using yen as a carry trade strategy right now is not so attractive anymore versus 3 weeks or since the start of this year. So that's actually explained to us why the dollar yen weakened drastically yesterday based on this intermarket play that causing this negative feedback loop into the dollar yen, because the yield spread, the yield premium between the US Treasury yield and the JGB yield has shrunk to a significant level, and yesterday it triggered down a further potential negative feedback loop by the break of their respective medium-term support level, which I just highlighted earlier on. Okay, so this is the intermarket dynamics that I want to share with you all on the FX market. So now let us move on to the interdynamics that I want to share with you all on the US stock market over here. So let me open up the chart talking about that bull steepening that has its impact on the value-oriented US stock sector, or the US stock indices, which is the Dow Jones Industrial Average. Okay, so let me load the chart over here. Okay, give it a minute to load, because I didn't open up the chart previously. Okay, so hopefully, yeah, good, it's loading. Okay, so let me open up this chart. Yeah, great. Okay, so this is the one I'm sharing with you all. Okay, give a couple of seconds to load. Yeah, because it's okay. Excellent. Okay, so this chart I'll share with you all at the bottom. This is what I call the bull steepening that is taking shape between the spread between the 10-year minus the 2-year spread over here. So in short, bull steepening, what it means that at this moment in time, the 2-year Treasury yield is actually falling at a faster rate than the 10-year US Treasury yield. So previous incident of this steepening actually took shape in the past during the COVID period, August, around this from this period over here. That means from April 2020 to March 2021. So during this steepening phase of this US Treasury yield curve, we start to see the S&P 500 value factor ETF outperforming the normal market cap S&P 500 by just using the SPVW. So it's actually the S&P 500 ETF value enhanced ETF. That means what it means here is that the ETF manager re-rank the S&P 500 component stock according to the value factor. That means those stocks that has a higher value factor will be ranked at the top. Okay, so this will be a slightly different way of rejiggering the component weights by the normal S&P 500, which is being ranked by market cap. Okay, so there was this up, the ratio actually went up. That means indicating to us that the value factor is actually outperforming the market cap S&P 500. So what you see over here is that this potential bull steepening will be more enhanced or more reinforced with the bullish breakout of this key resistance at negative 0.08%. All right, it hasn't hit there yet, but it's slowly inching up away. So once it's clear this level, potentially the bull steepening may enhance further over here. So what you could see over here is that even though it hasn't break, the ratio right now of the value ETF divided by the market cap S&P 500, that means that's the usual normal S&P 500, has started to inch upwards as well. Okay, so and what's interesting over here is that during this steepening phase in the past, the momentum ETF actually underperformed the normal S&P 500. So what is momentum? Momentum basically is the S&P 500 ETF is being rejiggered where momentum factor component stocks that has a higher momentum value will be ranked at the top. And currently, the momentum factor that has a higher component stocks within the S&P that has a higher momentum factor is all centralized on the mega cap technology stocks. So actually, you can just Google SPMO. You're able just look at the fact sheet, just Google it. On the very monthly end of the month, this ETF manager, Invesco, will release every month their latest top 10 holdings of this SPMO. So the top 5 or the top 6 or 7 are all inside the are all the mega cap technology stocks with the likes of Nvidia, Apple, Microsoft, Google, Facebook, whatsoever Meta, pardon me. So because these stocks are actually outperforming since the start of this year or even 1.5 years ago by looking at their rate of change against the other S&P 500 component stocks. So this is how momentum is being measured. So what we could see over here is that the steepening has started to take shape since late last week, which I highlighted, and this is where you start to see the momentum stocks starts to actually underperform. It starts to tilt down slightly against the S&P 500. So this actually explains to us why the Dow Jones Industrial Average managed to help the Ford yesterday. Okay, so if you put this bull steepening over here and you plot it directly with the index itself, you also have the same effect as well. So what I did over here in this chart is that this point here, October 2022, is the start of the most recent major uptrend phase of the Nasdaq 100, and it's still in uptrend because it has a big break above the major support level and it's still trading above its 200-day moving average. So I could see over here these two lines are actually the ratio of the Dow Jones Industrial Average are just divided by the Nasdaq 100, because Nasdaq 100 is being the top leader right now, not since the start of this year and even since the start of the COVID period, if you look at the longer term perspective. And the bottom, the light turquoise blue one is the Russell 2000 divided by the Nasdaq 100, which is so playing a catch up yesterday. So what's interesting is that Russell 2000 actually fall as well. So I believe that this fall is more related to profit taking because of its very significant movement that was seen in the last week, okay, which is up, I think, close to accumulated of 10% or so. Okay, so what I could see over here is that both of the ratio, the momentum of these two ratio has started to show bullish divergence. And what I could see is that the bullish divergence also being accompanied by this potential the bull steepening that I flashed to you all in the previous chart as well, which is the same calculation using the 10-year minus the 2-year treasury spread. And the previous bull steepening during the COVID period, that means i.e. from April 2020 to all the way up to March 2021, we start to see the period where these two ratio actually inch upwards as well over here. Okay, notice this part here where these two lines actually inch upward. That means indicate to us that during this period where the bull where the steepening takes shape between the US Treasury yield curve, that means i.e. using the 10-year minus the 2-year, it actually led to the outperformance of the Dow Jones and the Dow Jones Industrial Average and the Russell 2000 at this point in time. So it seems to us that this very similar phenomenon or observation in the past is now playing out as well. All right, so this is one of the key intermarket dynamics more on the longer term, medium term basis that we should pay attention to. That means, i.e., going forward into the second half of this year, which is right now the second half of this year, potentially we may not see very strong movement on the Nasdaq 100 in terms of the momentum rate of change as compared to the early start of this year, mid H1. All right, so this H2 over here is more or less being concentrated on the Dow Jones and as well as some form of the Russell 2000 playing a catch-up to cover the gap between the high-flying mega cap technology stock that is heavily weighted in the Nasdaq 100 and as well on the S&P 500. All right, so with that, that sum up the intermarket dynamics that I want to share with you guys. So now let us now shift our focus more on a very short-term intraday basis, which is the intraday technical outlook on the respective key cross asset classes. So let us start with the FX market first. So before we start that, let me expand my screen so that you guys could see the key levels much more clearer on your screen. Okay, so starting with the FX market over here. So let's start with the euro dollar. So euro dollar yesterday, we are actually looking for that setback to take shape, but unfortunately the setback didn't take shape below the 1.095. It also didn't break below the downside trigger level at 1.087. Instead, it starts to shape a higher high and higher low. So what you could see over here is that we got to respect the short-term trend. That means, i.e., the impulsive up move of this short-term minor uptrend phase that kick-started from the low of 26th of June continues to resume its potential positive or bullish momentum at this juncture. So what we could see over here is that I'll use yesterday's short-term pivotal support level. Is a very tight support level to have a better put it the way that to actually be much more prudent, because once a resistance level break, it shouldn't actually break below it again, because that was a former key short-term pivotal resistance, now turns into a short-term pivotal support. So it's at 1.0905. It's actually a range of 1.0920, 1.0905. So I just use the lower limit, 1.0905 level. So as long as any potential minor dip shouldn't break below 1.0905, if it didn't break below it, then we will flip to a short-term bullish bias on the euro dollar to resume its impulsive bullish structure or sequence to test the next near-term resistance at 1.0960 / 1.0980, and above it may see 1.10 figure coming next. And this 1.0980 is pretty key because of this dotted gray line here. So what is this dotted gray line? So this dotted gray line is in fact the major symmetrical triangle range resistance that I drew from the high of 19th of July 2023. So that's almost a year ago resistance because it's major. So if a breakout above this 1.0980 level, that means, i.e., we could have a daily close above it. It really signifies to us that the euro dollar has undergone a bullish breakout structure above its major symmetrical triangle range resistance. So that could actually also further having a further positive feedback loop on our put so that maybe it's a positive negative feedback loop for more dollar weakness coming back into play. Why? Because the euro dollar is considered one of in fact it's the highest weightage we call it currency inside the dollar index. Okay, over here only an hourly close below 1.0905, that means a breakdown below 1.0905 hourly close will invalidate today's intraday bullish bias to actually reinstate that corrective setback scenario back into the picture again to retest 1.0870. Below it exposes 1.0840, which is the lower limit of this minor ascending channel that I drew from 26th of June. All right, now sterling dollar. So the sterling dollar, same thing as well. It continues to push up higher and cleared above the 1.3010 level, despite the fact that the CPI number in UK came in within expectation, where it actually further kind of supports the potential first interest rate cut by BOE next month, but markets continues to actually favor a positive momentum on the sterling dollar due to the fact of a broad-based dollar sell-off yesterday. So with the break of this 1.3010 level, so I got to respect the momentum. So it's also telling us that the minor uptrend phase continues to resume over here. There's no signs of a much more deeper setback. So I would flip to a bullish bias for today, since the 1.3010 level has already been taken out, using yesterday's minor swing low during the start of the okay, actually this was Tuesday, not because this was Tuesday minor swing low at 129.50, which is also correspond very closely to the lower limit of this minor ascending channel from the start of July this year. So as long as any potential dip didn't break below 1.2950, we will have a bullish short-term intraday bullish bias on the sterling dollar. The next resistance level to watch out for after 130.65. This was the second resistance that I highlighted after the break of the 130.10 short-term pivotal resistance yesterday, will be at 131 figure slash 131.55, which is a bunch of Fibo extension level taken from the low of 27th of June over here, and also the top of the upper limit of this minor ascending channel as well. Only an hourly close below 1.2950 will invalidate this bullish bias on the sterling dollar to reinstate that minor corrective setback scenario unfolding again, to expose the next near-term support level at 129 figure level, followed by 1.2845 figure 1.2845 support level next. Okay, so net overall it's still within a short-term uptrend phase that is still intact, and only that yesterday's movement resumed its bullish impulsive move doesn't actually supports that initial thought of a much more minor, or I put away that minor mean reversion setback scenario to unfold. So we got to respect the bullish price action that has taken shape yesterday. Okay, so this for the sterling dollar. So let us now move on to the Asia Pacific dollar pair over here, starting with the Aussie dollar. So the Aussie dollar also came down a bit, but managed to help right at the support level that we highlighted, slightly above the short-term pivotal support at 67 figure level, which is also close to the rising 20-day MA. So with that, no change. The hourly RSI also going to shape higher low. All right, so very clearly signs of positive short-term momentum continues to remain intact in the Aussie dollar. All right, over here is the Aussie dollar. Okay, so that so I can see the legend of the Aussie dollar. So with that 67 figure level, still the short-term pivotal support, maintain that short-term intraday bullish outlook, because yesterday we flipped to a bullish bias on the Aussie dollar because it actually did that minor setback earlier at the start of this week. Okay, so the minor setback has really more or less been done. So now it's doing that impulsive bullish sequence within this minor uptrend phase that I drew from the low of 28th of June, the channel, okay, the minor ascending channel. So first resistance to watch will be at 67.60 on an intraday basis. Above it sees a retest of last Tuesday and last Friday minor swing high area at 67.90/68 figure level. Only an hourly close below 67 figure level will invalidate today's intraday bullish bias on the Aussie dollar to shape that much more deeper minor corrective pullback scenario, exposing the next near-term support at 66.70, which confluence with the rising 50-day moving average. A break below it may see a steeper down move on the intraday basis to retest the minor swing low of 2nd of July at 66.40 next. All right, so now moving on will be the dollar yen. So dollar yen, we initially wanting to have a view that the dollar yen will actually shape a much more pronounced corrective bounce before another we call it bearish downleg unfold. So initially we have that 59.45 59.90 level, which is the 20-day moving average. So price action, instead of hitting up higher, it can't do that, and it broke below our short-term pivotal support yesterday, which was 157.45. It broke down very clearly. So very clearly right now, right, since it can't actually even hit the 20-day moving average, it's now involving within a minor downtrend phase. Very clearly, if you look at the price action, it's now evolving in a minor descending channel, and we got to respect the intraday price action, which is more skewing towards the bearish impulsive sequence right now. Okay, so with that, it actually broke down 15745 and hit the next few support level that we highlighted, 156 level. It already hit that level and it now start to bounce. So what we could see over here is that the hourly RSI also starts to exit right now. So potentially, right, it may start to do a bit of more minor corrective bounce, but this minor corrective bounce, there is some form of clear resistance at this area here at 15745/70. And I did mention that given the fact that it's now trading inside a start of a minor descending channel, that means i.e. it started to kickstart a minor downtrend phase. So if you were to trade with the trend over here plus yesterday's bearish impulsive move, it will be not so prudent to actually look out for a much more counter trend rebound as a much more steeper reaction of it, because there's only a little more room to go, that's all. So I'll rather wait for the price action to come somewhere close to this level here at 15745/70. Then we'll flip to a bearish bias on the dollar yen instead. And if you do the Fibo retracement over here, okay, of yesterday's sell-off move, okay, it also corresponds to the golden ratio as well. For this previous pivotal support now turns into a pivotal resistance. All right, so using 15745/70, so 70 is actually the excess over here. Why? Because of the minor swing low area of the body, and as well as very close to the upper, in fact it's the upper limit of this minor descending channel as well. So as long as this bounce didn't surpass 15770, we'll flip to a short-term intraday bearish bias on the dollar yen to kind of respect is yesterday's intraday bearish impulsive price sequence. First support level to watch, there will be the 156 figure level. A breakdown below it exposes 15510/15475, and below it, it actually sees a further weakness towards 15390/70, the 1.236 Fibo extension level that I drew from the high of 3rd of July, and as well as the lower limit of close to the lower limit of this minor descending channel, and graphically is the minor swing low area of 16th of May. So there is some form of multiple confluencing factor taken from different angle, all pointing to the same support area at 15390/70 after the breakdown of this 15475 nicks. All right, so it's something like a magnetic area to look out for on the dollar yen on the bearish side of the story. So if we start to see the push up that surpass above 15770, then this intraday bearish bias will be invalidated on the dollar yen to see another round of very messy corrective bounce again to take shape. So the bounce resistance level to watch out for will be at 15880, followed by 15945. That means a revisit at the 20-day moving average. Okay, so this will be a zone that is acting as a resistance. So it's okay, let me, yeah, 15945/90. Okay. Okay, so that's for the dollar yen, and also sum up the short-term intraday technical outlook for the major FX pair. So now let us now shift our focus to the outlook for the major stock indices, starting with the Asia Pacific major stock indices, which is the Hang Seng Index. So for Hang Seng Index, surprisingly, it managed to actually bounce from our support level, didn't actually sell off or a negative follow through from the US stock market. That means, i.e., yesterday's US sell off on the Nasdaq 100 and the S&P 500 didn't have a negative spillover to the Hong Kong 33. So the reason why, later I'll share, there could be one fundamental reason why is related to a particular news flow. So I will actually share more during the when I share with you what are the key things to look out for towards the end of the session today. So, but however, we still got to respect this support level, which I highlighted earlier yesterday at 17,660. So this level is indeed hold because price tested 1 time, 2 time, 3 time, and today's at the start of today's Asia session, it staged a very strong bullish candlestick in the last 2 hours. And also the hourly RSI now, after that bullish divergence, it managed to clear above the 50 level mark. All right, and also the former minor swing high over here, which is something like a resistance level as well. So there's a bit of positive momentum coming back into the Hong Kong stock market, or the Hang Seng Index as per se, and our platform we call it the Hong Kong 33. So we still maintain that short-term intraday bullish bias, so we still got to respect it. First resistance to watch will be at 17,900. We also correspond to the 20-day moving average as well. Breakout above this level may expose the next resistance level at 18,225. Okay. Only an hourly close below 16,660 will invalidate today's intraday bullish bias to see a retest on the 9th of July and the 10th of July minor swing low area, which is the next near-term support level to watch at 17,430/17,360. Below it exposes the key medium-term support zone at 17,200/110, which is also the 200-day moving average, and as well as the former minor swing high area of 13th of March and 10th of April, where this level, okay, sorry, it's hang again. Okay, gosh, what happened? Okay, yeah. Where once this level breakout, it actually triggered that rather very steep and forceful rally that took shape from late April to 20th of May, this area. So this is something like a very key psychological level. So I name it as a key medium-term support zone to watch out for, because it also corresponds closely to the longer-term key moving average, which is the yellow line here, the 200-day moving average. All right. Now, Nikkei 225 or the Japan 225. So Japan 225 yesterday broke down below our short-term pivotal support at 41,090, and it hit the next support area on the downside at 425 level. Okay, and managed to store over here. Okay, right now, and it's so close to the 20-day moving average, and as well as this minor ascending trend line support that I drew from the low of 17th of June. All right, over here, this dotted gray line. Okay, so net overall, there is some form of graphical support and moving average support right now. That is price action is now starting to actually consolidate at this juncture over here at this point in time, and also the RSI has started to manage to exit from its oversold level. So net overall, what we could see is that after yesterday drastic fall off, we are not taking things one step at a time. There could be a minor bounce that is taking shape for today on the intraday basis, because this is an intraday technical outlook using the hourly chart. So we will use 39,950 level, okay, slightly below today's low over here, which is the minor congestion area of 28th of June, and as well as 2nd of July as my pivotal support for today, 39,950, slightly below 40,250, the support that we highlighted yesterday. So as long as this 39,950 short-term pivotal support holds, potentially there could be a minor bounce taking shape. That means for today, we do have a short-term intraday bullish bias for this bounce. Resistance level will be at 41,090 level, which was yesterday's key pivotal support, now turns into a pullback resistance, which is pretty significant. Why? Because previously it managed to help 3 times. And if you look at this 41,090, looking at the Fibo retracement of taking to yesterday's sell-off, okay, it's a bit slow right now. Okay, let me do it again. Okay, good. Okay, it also corresponds to the golden ratio at 61.8%. So something to look out for, something like a magnetic area in terms of because it's being confluenced by different factors, all pointing at the graphical level of 41,090. Okay, then but if it starts to break down again below the 39,950 later during the session, as the session unfolds, then we got to respect the price action and the bullish bias for that that minor bounce scenario will be invalidated to see the continuation of this impulsive down move. That means the kind of the multi-day corrective down move will extend to expose the next support area at support level at 39,350, which correspond to the rising 50-day moving average. All right, but if you start to see a breakdown below 39,350, then its medium-term uptrend phase will be in jeopardy. Why? Because price action going down below the 50-day moving average doesn't looks good on the Japan 225, and it may start to expose the next. That means this minor corrective scenario may be turned out into a medium-term downtrend phase going forward. All right, and the next support level to watch in the near term after 39,350 will be at 38,750 in the first step, which is this minor congestion area of 19th of June and 25th of June. So that's all these levels are based on a movement of a intraday basis. So hoping to actually be achieved within one trading session. If 39,950 breaks down, then 39,350 below it sees 38,750. All right, so this is how we look at things. Okay, so everything, all this is on the intraday basis. All right. Now, going forward, this sum up the Japan 225. Then let us move on to the European stock indices. So for the European stock indices, the German 30 or the German DAX yesterday managed to float down lower and hit the 20-day moving average before staging a bounce off it over here. So now potentially, right, what we could see over here is that it's still trading within this very complex, messy, high volatile situation, because it's in an expanding wedge, because that's why you see the line of the higher high and the line of the higher low starts to expand. So it means it's a very volatile short-term situation. And based on a idiot wave perspective, initially at the start of this week we were bearish, and it came down, all right, and hit the 20-day moving average. And the way it came down over here, there is a 5 move down move structure, 1 2 3 4 5, and yesterday's low also hit a 0.618 fifth wave target. All right, in terms of an Elliott wave perspective over here. Okay, let me draw the line again, because okay, sure. Okay, gosh, the internet connection is a bit slower. Okay. Okay, let me draw again. Hopefully it works. Come on. Oh, gosh. Okay. Okay, so basically taking from the length of wave 1 to wave 3, project it to wave 4, you see the 0.618 exactly at yesterday's low, okay, which is also the 20-day moving average. And once it hit the fifth wave target at 0.618, the RSI also went down to the oversold region as well. So net indicating to us that yesterday's low over here, this could be the minor exhaustion point of this 5 wave down. In terms of an Elliott wave perspective, after 5 wave down, be it in a hourly time frame or 15-minute time frame or day time frame, that could be a retracement of this 5 wave down. So potentially retracement is around the 50% to the 61.8% Fibo retracement of this previous 5 wave down. So if we were to look at the Fibo retracement over here, taken from account of yesterday's 5 wave down, okay, you see the 61.8% at the 18,630 level. So that was the pivotal resistance that we have yesterday. Slightly extension will be at the 18,700 level. Okay, so net what we'll do over here is that, because this is an intraday technical outlook, so using 18,380 as my short-term pivotal support level, which is being confluenced by different factors. Elliott wave perspective, 5 wave down, 0.618 Fibo wave 5 target, the 20-day moving average acting as a support, and previously there's some form of congestion area over here as well graphically, all right, from 10th of July. So 18,380 short-term pivotal support level holds. Potentially there could be a minor bounce taking shape. So for today, we're flipping to a short-term bullish bias for this potential minor bounce to unfold based on the current technical, short-term technical elements that is displaying right now, which I expressed to you earlier on. Resistance level to watch on this potential minor bounce, 18,630. Above it may see a bit of extension towards the 76.5% retracement. Also this minor congestion area over here at 18,700. All right, only an hourly close below 18,380 will invalidate today's intraday bullish buyers for that minor bounce scenario to see the continuation of this down move towards the lower limit of this expanding wedge. The next near-term support level to watch, 18,235, followed by 18,150, which is the lower limit of this expanding wedge. That's for the German 30. So now moving on will be the major US Wall Street indices. Starting with the Dow Jones Industrial Average, which is the US Wall Street 30, now is being the top outperformer among the major US stock indices. So yesterday, we are actually looking for a minor setback scenario to take shape towards 40,390, but this minor setback did actually unfold as intended because it only printed a low of 40,865 yesterday before breaking above our short-term pivotal resistance at 4185 level. All right, it broke above this level, and it also broke above the minor ascending trend line upper channel that I drew from the low of 19th of April, this dotted gray line here over here. Okay, so it broke above it. So what I could see over here is that the US Wall Street 30 now is doing some form of minor bullish acceleration. Okay, so with that, I got to respect the price action. So yes, you may do a bit of minor setback towards 41,050 level, which is close to that upper channel resistance, now turns into a pullback support level, given the fact that hourly RSI has already hit the overbought level. But as long as this surpass yesterday's minor swing low, which is or yesterday's low during the start of the US session at 40,855, we will flip to a short-term intraday bullish bias again to see the continuation of this impulsive up move. Next resistance level to watch, 41,500, followed by 41,900, which is a 3.618 Fibo extension level. Okay, and if you do another extension Fibo extension level, taking into account of this latest push up from the low of 9th of July over here, we project it up to this level, push it down. It also correspond to another Fibo extension level right exactly at 41,900 based on the latest price structure at 4.382. So it's a bit like a magnetic level to watch out for. Okay, only an hourly close below 40,855 will invalidate today's intraday bullish bias on the US Wall Street 30, i.e. the Dow Jones Industrial Average, to kind of reinstate that minor corrective setback scenario within its short-term uptrend. Why? Because why short-term uptrend phase still intact? Because it's still trading above the 20-day moving average, to expose the next near-term support level at 40,390, followed by 40,185 slash 40,060 next. Okay, so that's for the US Wall Street 30. Now moving on will be the Nasdaq 100. So Nasdaq 100 yesterday broke below our short-term pivotal support level at 20,210. So you got to respect this price move is breakdown and hit the support level that we also highlighted previously at around 19,820 next after the 20,210 level has been broken down. So it seems to us that right now, right here, the next support level to watch will be this area here, 19,660, 19,520, which is so close to the medium-term ascending trend line of 19th of April, and as well as the 50-day moving average. So what I could see over here is that yesterday's sharp down move seems to us that right now it's kind of being involved in a very short-term intraday bearish dynamic that is still intact because there's still some more room to go before hitting this support level. And at this point in time, the hourly RSI will go to the oversold zone. So potentially there could be a revisit of this 20-day moving average right now, I think, as a resistance. That means there could be a bit of snapback bounce on the intraday basis at 20,060 level. Maximum yesterday's minor, yesterday's short-term pivotal support now turns into a very clear short-term pivotal resistance at 20,210. So as long as this bounce didn't surpass 20,210 level, we will flip to a short-term intraday bearish bias for this minor corrective decline to play out, to kind of test the 19,660 slash 19,520 support zone next. All right, only an hourly close above 20,210, then that will actually see the resume of the recovery or the bullish impulsive upmove sequence again to unfold, to retest the current all-time high area at 20,620 slash 20,710. Then thereafter above it may see the next resistance, which is defined by some Fibo extension level at 20,900 next. All right, so with that, that sum up the short-term intraday technical outlook for today on the major stock indices. Now let us focus on the commodities market, starting with gold XAU/USD. So for gold, yesterday we still have a bullish bias, so we're expecting the pullback to take shape. All right, after hitting a fresh new all-time high around 2,480. So yesterday the price action tried to hit the 2,480 again and came back down. All right, so very clearly the pullback is taking shape. So this will be a first support level to watch, okay, because this is a minor swing low already. But I don't want to use as a minor short-term pivotal support area right now because it's a bit tight right now over here. Because if you were to draw another much more steeper ascending channel, taking into account of this latest fresh impulsive up move leg over here, okay, so this is something like this over here. Okay, a much more steeper one. Yes, this may form the first support level, but I still want to maintain the previous support level of 2,433. Okay, a bit of breathing phase, breathing space over here. So as long as 2,433 short-term pivotal support holds, we will still maintain that short-term intraday bullish bias for this impulsive upmove sequence to play out much further. The next resistance to watch will be at the 1.618 Fibo extension level, okay, that I drew from the low of 26th of June at 2,510. Also right now also correspond to the upper limit of this rather minor steeper minor ascending channel that I drew from the low of 9th of July. Okay, and above 2,510 may see 2,532 next, okay, on the upper side of the story of the narrative. Now, if it starts to break down below 2,433, then it may start to invalidate today's intraday bullish bias to unfold a minor corrective pullback sequence to expose the next near-term support area at 2,417, 2,393, still trading within a short-term uptrend phase. Why? Because it's still trading above the 20-day moving average. Right, so that's for gold XAU/USD. Now moving on, next will be the West Texas crude oil. So yes, West Texas crude oil, yesterday we flipped to a bullish bias to play that bounce. So that bounce actually surpassed our resistance, which we have around 82.50, which is the 20-day moving average. And where is it right now? The rally actually stopped exactly at this minor descending trend line that I drew from the high of 5th of July. Okay, 5th of July over here. So with that, potentially, and also the hourly RSI will hit the overbought level, there could be a minor setback that could potentially unfold in today's session. So using 83.77 as my short-term pivotal resistance, flip to a intraday bearish bias for this potential minor setback scenario to unfold. First support level to watch 82.50, below it exposes 81.77 in first step over here. Only an hourly close above 83.77 may see a bullish breakout, then i.e. we may start to see a much more pronounced bullish sequence coming into play. Why? Because it starts to shape a higher high. So totally eradicate this corrective down move, which is still displaying lower high, lower low at this moment in time. So if it starts to turn down, definitely it starts to form a lower high over here. If we break up 83.77, there is a higher high where we may start to see yesterday's move turning into a much more pronounced recovery scenario, with the next resistance level to watch in the near term will be at 84.40, followed by 85.55 next on the West Texas crude oil. All right, so that sum up today's intraday technical outlook on the major cross asset pair. So before we go, let's take a look at the economic calendar to see what are the key data points to look out for today. So for today over here, if you go to Thursday, let me scroll down. Okay, so Thursday, what we have at this point in time during the European session will be some job data up from UK at 2 p.m. Again, the unemployment rate and the unemployment change in UK. And over here throughout the European session will be rather quiet, except at 8:15 p.m. where we start to see the deposit, the ECB, pardon me, interest rate decision. More or less, markets were expecting no change at 4.25% based on the last few public speeches of key ECB officials, where they did mention that they need to assess the situation of the US, okay, not the European economy after their first interest rate cut that took shape last month. Okay, so what's key over here is will be the press conference by Lagarde that is out at ECB President Lagarde at 8:45 p.m. later, where market participants will be gearing towards her thoughts of what next in Eurozone, because most likely market is now pricing in a September cut by ECB. All right. So market participants will be hearing the thoughts of Lagarde as well, how she's going to actually face this expectation, or how to actually, she has actually put away that how she's going to actually guide this current expectation of another interest rate cut that market participants has started to actually place significant bets on, to actually have another cut in September by ECB. Then during the US session over here, we do have leading conference board leading economic indicator that is out at 10 p.m. Singapore time. And very interestingly, after the press conference, ECB President Lagarde is speaking again on some public speeches. I think that shouldn't be much of an impact. So whatever she would like to mention should be mentioned at 8:45 p.m. And what's interesting over here is today will be the final day of the China top policy maker. One of their we call it put away that one of their work plan seminar that is very important. So this work plan seminar focus on the economic agenda and strategy that the top policymakers want China, we call it, to undergo in the next 5 years. So they call it the third plenum. So today will be the last day of the third plenum. So it's a closed door session. So usually the last day on today, you will have the press release from the third plenum of what are the key agenda that has been discussed and what is going to be implemented. So that also explained to us why the Hang Seng Index managed to actually support at the key support level that I highlighted to you earlier at the start during the key technical outlook on the Hang Seng Index. So market participants seems to be looking at some form of a much more forceful physical stimulus that may come out from the third plenum. Okay, then we shall see. Okay, so very likely it should be around 5 p.m. Singapore time. That'll be at the end of the day, all right, during the Asia session, for any form of a message or a news broadcast that broadcast the outcome of the third plenum then. Okay, so with that, do have a great day ahead, and we shall speak again tomorrow. This is Kelvin here, signing off. Thank you.